gold has a languishing, bottoming, and coming back up, in my opinion, period, but in the range of the last high and now during the rest of the year. In short, my expectation is every single one of those calls will expire worthless. 6,000, 8,000, 10,000, 15,000, and 20,000, and will have served their purpose for the person who was also selling calls lower down at 4,200 and bought calls, much cheaper ones, far, far away, that reduced the amount of capital by a huge multiple that they had to pledge and lock in their account because they wrote calls. That's what's happening.
Gold markets are navigating a complex technical consolidation following a steep blow-off move. Despite strong fundamental news enticing market participants, immediate technical chart patterns clearly signal that a prolonged resting phase is required before any sustained upward momentum can resume. Francishunt, a seasoned market strategist and technical analyst, emphasizes that all extremely high out-of-the-money call option strikes ranging from $6,000 all the way up to $20,000 are projected to expire completely worthless by the end of the year. He argues that technical indicators on 6-month timeframes, particularly a prominent red shooting star candle following a multi-year bull run, suggest gold will struggle to surpass its previous high of $5,600 within the remaining months of the year. While a short-term price recovery from lower levels is expected, upside potential remains strictly capped due to heavy derivative option selling by institutional traders seeking premium. However, long-term macroeconomic prospects remain exceptionally bullish, with physical silver predicted to eventually reach $330 over extended timeframes. Now, we present the clips from Francishunt's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Nonetheless, it won't stop me getting a bit long gold because I expect it to recover. I just don't expect a new high this year. I don't expect January again. Remember, I did the previous years. I showed you how you had 20 years of suppression. Let's go and cover that again for those that are new. We'll have to get a longer one than Tickmill. The 20 years of suppression that occurred during 1980 through to 2000. They were able to suppress for 20 years, 1980 to 2000. Then they were able to suppress into this low, roughly 5 years. Then you were held flat and you went to a low from that last high within about 3 to 2 years. I think it was about 2.5. 2.5 years, 25, 2.5. The suppressional ability is getting less. However, we did grow. We did grow and we got high volume, the fatter candles. We got high volume and we ran into a blow-off event that was quite steep and takes a bit of digestion. It takes a bit of digestion. A lot of folk got a bit too excited. So overall, the periods and the gaps in between will be less, but that, my friends, is a shooting star with a red follow-up candle. And we did just finish the 6 months, the first 6 months of the year, and we showed you in 6 months as well. And it is all one big shooting star. And it was on increasing volume. Look at the breadth of that little hammer there. That was the final low, that date after that high. Yes, look at the breadth of that candle. Fatter, 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 and fatter still. That's right. And then eventually the fat lady sang and she said, "Go home now, the opera is over. Cash in your ticket short term, come back soon. We will go higher and sing again. But right now we rest." 1 green, 2 green, 3 green, 4 green, 5 green, 6 green, 7 green candles. And in fact, before that, that was actually green, and so was that. So you can say 9 6-monthly green candles in the setup of that break on expanding volume, expanding volatility, giving you a blow-off event shooting star. And it's amazing how many people that tell you they're technical analysts, but all expect a 20K, a 10K, a 9K, a 6K as a probability by the end of this year or by the end of the summer. How long is summer? I don't know. Is it deemed spring by September? So you have what's left of July and August? No. The technical analysis of this chart is that you've had on a 6-monthly time frame, friends. And the one thing I am is technical, and I can't tell you that I feel comfortable with calling for new highs for anyone. And I want it. I love it. And fundamentally, there's so much fancy news going on and all of it. We all just want to party. Everybody wants to party. They've all worked so hard. But here's the truth. You've had 9 6-month periods of green candles on escalating volume, escalating volatility that led to a blow off, and you are staring at a 6-monthly shooting star, which is red and has a rejection from 5,600 and came all the way down. The betting money of technical neutrality does not assume the next candle is green, never mind runs the high. You do not even assume the next candle after that to be green, my friends, never mind running the high. So ironically, I find myself, who is a devoutedly technical person, when others are losing their technical aspirations and inhaling the hopium of the high that we had in January and ready for Mark 2 and Mark 3, the chart tells you it's unlikely that by the end of the year you will run the 5,600. To me, this is a fairly safe bet technically to say, as unpopular as it will seem. That will mean your 6 gray call guys have lost everything on those calls. Let's go back. At 5,600, me saying you won't make 5,600 this year is an easy, safe bet for me. Can I be wrong? Of course I can be wrong. I can draw the 10th straw and it's the wrong one, but on the other 9, I'm winning. I can certainly be wrong, but that strike ends up worthless. Those 1,007 calls, worthless. Those 8,000 calls, worthless. Those 10,475 of them, worthless. The 15K, 1,029 calls at 15K expire, worthless. Zero, zip, nada. You had a lottery ticket and you had as much chance as the lottery to win it. It's a tax on the stupid, lottery tickets are. But these people might own these for a different reason. And we'll be covering that now. But I first have to say the 20K strikes, 911 of them, witchy number, are going to be shown to be worthless on balance of probabilities. So why then are people rushing in and buying them? If it's not insiders, if they're not being given a nod and a wink, and believe you me, there's plenty of that going on.
Option market dynamics reveal heavy institutional activity centered on capping precious metals within a defined range over the next several months. Derivative traders are actively selling calls at elevated resistance levels around $5,300 to collect premium, while simultaneously purchasing far out of the money hedges to reduce capital requirements. This systematic option writing creates structural resistance, predicting that gold prices will remain largely confined to the $4,000 range, with only brief spikes into $5,000 before year-end. Furthermore, a sudden demand-destroying macroeconomic crisis could trigger a temporary downside flushout, despite positive technical falling wedge patterns. Long-term accumulation of physical gold and silver remains highly advantageous at current valuation levels, as current price suppression mechanisms gradually lose structural efficiency over shorter cycles. Derivatives are expected to cap short-term momentum, ensuring high strike calls expire without value while establishing a base for future secular rallies. Now, let's get back to the interview.
At gold at 6,000, 8,000, 15,000, 20,000, you name it. But until then, I'm saying 75-25. It's call option strategy buying after a blow-off localized high of volume, volatility, and nine half yearlies. That's 4.5 years of trading up on a 6-month candle on ever expanding volume and volatility. We did get a localized high for now. It can turn quite quickly, we have said, but not, I suggest, in the next 3 months or 4 months to December. Okay, let's go see what you say. I seriously don't know how you can lose money buying gold and silver at 3,704K. For the long-term man or woman who is prepared to recognize this, I think it's a great buy. We will do shorter time frame assessment. This is what I'll do next and show you why I do actually think gold and silver is actually going up. But the reason the title also said it's bearish, that there's so much out the money call buying. Well, the reason we said it's bearish, it's not, we don't think gold's going to go down, but it is meaning closer to the market. There are people that are selling, likely selling options. So there is a lot of premium seeking, option selling, derivatives that are being applied, that are capping. So that's why I think we stay in range. I think we're that cheap and that good a value. You and I should take opportunities to continue to build our blue pot unleveraged for time frames beyond the expiry of this option that we're discussing. As ever, I am a macro bull. I'm just not so bullish in the next 5 months to December as we sit here on the 7th, 5.5, 4.5, whatever you want to call it, till the expiry. I think we recover. We don't make new highs. I think we recover. But wild card, demand destroying event, could even see the possibility, despite the falling wedge, you could have a flush out to the downside once if it's a big enough crisis. Long term, higher, pants on fire. Bull, bull, bull. We said 330 on silver at $26. As it broke, we said that's the last time you're breaking it. That's why we had fun with Brent Johnson's tweet. We were calling it the last time at $25 going up. And we still say that. But you can pull back for an extended period. I don't think people necessarily will get steamrolled selling gold calls. The question is the recovery. That doesn't mean they might. It depends where their strikes are. Not all of them are selling them at the market right now. I wouldn't, for all, if I'm on that institutional desk as a jobber and I get paid a bonus on, I would be selling, I'd prefer to sell 5,300 calls. And then I would buy 8,000 to cover me. Nice, cheap 8,000 and even 10,000 well out the market. And I'd collect premium. I think we can stay in the 4s and get the odd move into the 5,000, but not necessarily finish there. I would do that. I would sell 5.5. I would sell the last high calls and gather some premium, but you get less premium if you get too out of the money. People want to make money if you want to entice people. So some of the bigger bears or the people that look at the time and say, people overestimate what will occur in this time frame.
Historical chart patterns over the last 4 decades demonstrate that central market suppression periods are steadily losing momentum, shrinking from 20-year durations down to mere 2-year cycles. Recent price action across multi-month candles displays expanding volume and volatility, culminating in a localized blow-off top that demands market digestion. Technical probabilities lean 75-25 toward a consolidated trading range over the next 4 to 5 months, rather than an immediate breakout to new record highs. Short-term speculative lottery ticket options at extreme strikes are forecasted to face total loss upon expiration, benefiting institutional desk strategies that collect premium while capping upside moves. Despite these interim headwinds and the threat of an unforeseen crisis causing a temporary price dip, the underlying secular bull market remains completely intact. Long-term valuation metrics present extraordinary buying opportunities for patient investors looking to build core allocations in physical bullion. Silver is predicted to achieve a massive long-term upside projection of $330 per ounce, while gold continues its broader secular move higher over extended horizons beyond current derivative contract expirations. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.